Hi, folks. Today is Wednesday, November 27th. Welcome to another episode of Best Bitcoin Data Show. Today we have Dan Hillary, one of my favorite analysts, mostly focused on microstrategy, and he has a wealth of knowledge on the stock, its prospects, and the options. So why options? Today we're going to talk about this financial instrument that gives us pretty strong advantages. If we are right about Bitcoin's trajectory, next year is going to produce a rare opportunity to benefit from the upside of Bitcoin and MicroStrategy. And options will allow folks to lever up with capped risk. For example, if you buy a call option, this allows you to speculate on the upside of an asset without having to suffer a lot of consequences on the downside. So this allows one to lever up, for example, and there are a variety of option strategies. Actually, you could do a lot of sophisticated things that will help you achieve your financial goals better if you understand them. So it's important to understand them. Even if you're not going to use them, it's a very, very helpful tool to get a hang of it. And it can also offer insurance on the downside if you want to lock certain prices for yourself. If you feel like something has gone up a lot, you want downside protection, you can use options. They basically operate like insurance. And so today we want to hear and learn more about these instruments, and especially with application to MicroStrategy from Dan. And the other thing I'll say is the disclaimer. This is only for informational purposes. This is not financial advice. Always make sure you understand something before doing it. But we will do our best to explain what this tool is and how to best leverage it. Welcome, Dan. Welcome, Plan C.
Hey, it's great to be here. I think that was a really good introduction, Sina. These options contracts are so interesting because you can use them for so many different applications, whether it be, as you said, insurance or speculation, or even to try to acquire more shares based on speculation. So there are a whole host of different strategies you can use. You can even sell them and try to collect a premium. So they're not one thing. I think a lot of people think, oh, options contracts is risky. That's a financial derivative product. It's important to know them, understand them. Even if you're just analyzing the stock, you can look at the options chain, the pricing, and understand, okay, how is the market pricing the forward movement of the stock? And how does that affect my analysis of it? Perfect. I think you did a really good post about IBIT options, about how the probability distribution and the premiums, what it meant for the future probability of certain Bitcoin prices. I thought that was really neat, and that's exactly how the option chain should be used, in my opinion.
Awesome. Welcome, Plan C.
Yeah, hey guys, awesome to chat with you. And yeah, for anyone who's not following Dan already, highly recommended account. I was actually following quite a while ago, and yeah, love the content you're putting out, man. And as far as this subject, I think you and a couple other people are kind of at the tip of the spear in a lot of ways, understanding this. I haven't spent a ton of time on it at all myself, but I'm definitely interested in learning. So I'm glad you're here, and yeah, looking forward to it. Cool,
awesome.
Great. Okay, so let's see. Where do we want to begin? If it also depends a lot on how. Go ahead. What was that?
Yeah, maybe we look at the MicroStrategy price. We look at the volatility, and walk through a couple of MicroStrategy basics to get warmed up, and then get into it.
That sounds great. Let's do it.
All right.
If you want to share anything, I can show it here too.
Okay. I'm happy to share my screen.
Or if you want to send me anything, I can show that.
Are you guys able to see that? Is that clear? That should be you guys. And
yes, I can see. All right. Going to Twitter.
So let's see where we're trading for MSTR. $388 a share. We have had a pretty good run up here. And obviously this isn't new news, but what I want to show is a little bit of volatility. So as you guys know, options contracts are priced based on both volatility and expected return. And if you use the Black-Scholes equation, there's a term for both implied volatility, so the expected volatility moving forward on an annualized basis, and an expected drift of the stock, which is directionally where will it go. And so those are two terms we can use to understand how the options are priced. But first off, what's volatility? So volatility is an annualized measure of the expected movement in a non-specified direction over a year's worth of time. So, for example, MicroStrategy right now has about a 155% annualized volatility based on the 1 month trailing average. So, using the past month of data, MicroStrategy is expected to move on the options prices 155% over the next year, either up or down, or either which way. It doesn't work out exactly like that, but that's the idea. It's just to say, how much is the stock moving up and down? How quickly, how violently is the stock kind of vibrating?
I had a question actually around this. Do either of you guys know kind of because I haven't looked at it specifically myself, the version of this for Bitcoin? I know Cena's done some analysis on the volatility, like how much either on the monthly, or I guess probably maybe looking at it on a yearly kind of rolling annualized, what would be the difference between the two? Like how much more volatile is MSTR stock relative to Bitcoin as the underlying asset? Like what are we looking at for a differential there?
Cena, do you have good numbers on that? I have an approximation, but that's it.
No, I don't have the numbers.
Off the top of what I've had done over the summer is Bitcoin's about half as volatile-ish. I think Bitcoin's a sub 100 vol asset, whereas MicroStrategy here is right now trading at 155 volatility, whereas typically it trades around the 100 volatility range.
Okay, so it's I mean, if we looked at it on a yearly basis, I wonder what it would be, but it's at least, do you think it's at least double as volatile?
Or yeah, it's 1.5 and 2x as volatile.
Somewhere between 1.5 and 2. Okay, that's interesting. Okay, because that kind of gives people an understanding of the potential outsized returns, but then also, you are kind of signing up for a little bit more volatility there. It's not like 10x more though. If you're already
right.
holding Bitcoin, you're kind of accustomed to a degree of volatility. So it's just good to understand the difference between the two. So if someone has a position in both, they're kind of accustomed to Bitcoin. But if they've held Bitcoin for 5, 6, 7 years, they've already gone through this level of volatility with Bitcoin 5 years ago, or maybe 4 years ago.
Exactly.
So it's not like it's not necessarily anything new. It'd be new if you hadn't held Bitcoin and you jump right into MicroStrategy, and you're coming from more traditional equities. But yeah, I mean, I think it's like Bitcoin's, you're very accustomed to these levels. So just interesting. Thanks for sharing.
No, completely agree. And you can see kind of how these peaks line up. And it tends to be volatility both to the upside and the downside. But in general, as the price of both MicroStrategy and Bitcoin go up, the volatility of the asset goes up. And that's super special and unique to these assets because it doesn't happen with traditional equities. Traditional equities, as their price goes up, their volatility tends to decrease. And that has a huge implication in the options market, which we'll talk about in a second.
So let's take a step back and just use an example. Let's say we want to analyze a call option. I think call options are simpler to begin with. What does that do? That gives me the option to buy the asset at a higher price, but not the obligation. Why do I want this? Because I don't want to buy it right now for a variety of reasons, including maybe I don't have the money, or I want to lever up compared to the amount of money I have. And second feature of this is you pay a premium to own that option, and the premium is the maximum money you can lose, right? So another reason to buy a call option is to protect yourself on the downside, right? So because you only buy the right to buy it, if the asset crashes, it's only your option that expires. So the little amount of premium that you pay goes away. So that gives you protection on the downside and participation on the upside.
Exactly.
But there's also a time limit to exercising this. Now, all of this involves volatility because if the asset is very volatile, your option is much more attractive. there is a huge likelihood that it actually reaches the price that you've targeted. And if it goes beyond that strike price, you suddenly have the right to buy the asset significantly below the market price. And that will give you massive gains.
Exactly. And as Sina is saying, it's a leveraged right to buy, right? So when you buy an options contract, you have the right to buy 100 shares of the underlying. So what's unique about it is as the price of MicroStrategy or Bitcoin or whatever, or an equity rises above the strike price, the price at which you have the right to buy, as the market value appreciates above that right to buy price, you have leveraged returns relative to the stock. Relative to the stock's movement for a period of time, which we can get in later. But that's where the leverage comes in, because you own a contract to buy a large number of shares, 100 shares in a lot.
Yep. So volatility matters here a lot. Go ahead.
Well, exactly. And as you're saying, volatility, it's one factor which market makers and people selling the options and the free market use to determine how likely the price of an asset is to move above the strike price within the given period of time, which is before the expiration date. Maybe we just look at an options chain, and this is kind of complicated and confusing, but for anyone looking at home and want to just figure out what these things are, we can quickly read this chart and explain it.
So first off, let's step by step. What is the option chain?
Okay. The option chain is it's the pricing for options contracts. So much like you'd go and look at the price of Bitcoin, right? We need to go to the option chain as traders or investors and look at the different prices for different expirations, which is the day when the contract comes due, and different strike prices, which is our right to buy price. And so the option chain just is all that data, all that current market data.
Exactly. And it varies by the strike price. It varies by date. It also breaks it down by calls and puts. Again, just to make sure the audience understands, let's say I have I think Bitcoin will hit 300K sometime next year. Now, I might buy an option, a call option that gives me the right to buy Bitcoin at 150. Now, for any amount that Bitcoin goes above it, I'm getting leveraged return. So if it actually reaches 300K, I'm gonna be in massive amounts of profits. But all that depends on the length of the option too. If I make a mistake and the maturity date of the option, exercise date is too close, maybe Bitcoin finally reaches that point, but not by the date that I have purchased the option for. So generally, the options that give you more time, they are due at a later date. They tend to be more valuable. The ones that are closer would be cheaper. So the option chain would give you all these combinations, different dates, different strike prices, and each of them behave differently.
Exactly what Sina is saying. And for example, here, if you were to try to understand this in an options chain, you'd sort by date first. So this date here is the expiration date, when the call expires, when it either expires worthless, meaning the price of the asset is below the strike price, so you have the right to buy it. You have the right to buy it higher than it's trading on the free market, so it's not worth anything. That's a tough one to grasp. So it's the strike price, right? So for 360, let's say I have the right to buy MicroStrategy at $360 a share. Right now, that's valuable because $360 a share is below the market value of MicroStrategy. However, if you have a strike price of 470, right, the right to buy MicroStrategy at $470, that isn't intrinsically valuable. That it's still valuable. We'll talk about that, but it's not intrinsically valuable because you would be buying MicroStrategy for a more expensive price than it's trading on the free market. So that's the idea.
Mm-hmm.
So it's not valuable today, but it would be valuable potentially in like 6 months or something.
Exactly.
But if you bought it now, like why would someone buy it now? Because it's not valuable today. But it could become valuable, so they could sit on it and it could gain value. Like I don't understand that part.
Yeah, it's tricky because so right now the term we use is intrinsic value, and intrinsic value is the difference between the fair market value of MicroStrategy and the strike price. So if the fair market value is above the strike price, you can buy MicroStrategy at a cheaper price, so it's intrinsically valuable, right? But if you have one of these call options and it's going to expire in a year, let's say, now you're speculating, right? You're saying, okay, you're saying, let's say you have a 400 strike for MicroStrategy that expires in a year. If you bought that call, you'd be betting that in a year, MicroStrategy's price will be above $400 a share, and you'll be able to buy MicroStrategy for $400 a share.
Oh, okay, that makes sense then. Yeah, no, that definitely makes sense. Okay, so yeah, you're essentially kind of giving yourself that optionality going into the future, and that becomes valuable at some point because at some point, people will want to obviously get those prices, and if they're no longer available, now you have something that's valuable, and plus
Exactly.
you're giving yourself that future option for whatever reason, and it's also relatively cheap if you're getting it now because it's less in demand. So yeah, that's interesting. Okay.
And for every dollar that the price goes above your strike price, let's say you have one contract which gives you the right to buy 100 shares. For every dollar that the price actually goes above, you get $100 in profit. So and then you can sell that option at a much higher price. So, but the whole thesis depends on the price actually reaching that point. If not, you're losing money.
Would it be a good analogy to say it's like buying land in an area that you think will be developed in a few years and hoping that the price goes up for that land value? Is that a bad analogy, or is that a way of looking at it where you're essentially speculating that there's going to be a higher demand? I mean, I guess that's what this all is kind of, it's all speculation, but essentially saying like, I'm going to buy this cheap land that's outside the city because at some point the city's going to expand. Maybe that's a better way of looking at it. I'm going to buy land that's like well outside the city. The city's going to expand, and at some point, this land will become more valuable.
I think that's one way to think about it. Yeah, but if the city doesn't expand,
you're screwed.
As far as the land, right? Your land is worth absolutely nothing.
Yeah, exactly. That's exactly it. Yeah, if the city never expands, then your land is worth nothing. Like it's worth really, it never gets the value that you thought it would be, right? So okay.
And the person that sold you the land gets to take it back after 2 years if the city doesn't reach the land.
Yeah, there's a time component there. Okay, that makes sense.
Yeah.
So just a quick point, just to really, really clarify this. This is how your profits will work with a long call option. Initially, let's say you buy one call option that has a strike price of 100. That means you have the right to buy that asset at the $100 mark. If the market price is below that 100, you are not crazy, so you're not going to exercise that option unless you want to do a charity. You only exercise this if the price of the actual price of the actual price of the asset goes above 100, and then like I said, for every dollar you are benefiting from multiples of that. But at the same time, it's a market, right? So the option comes at a cost. So you have to pay something like $200 in this example as a premium. And as soon as you buy this option, you are in $200 in the negative, and you just have to wait until hopefully before the expiration, the price of the asset will exceed 100, and then you begin accumulating profits. And at some point you reach break even, and hopefully after that you make the money. The benefit is if the asset just gets destroyed, you're only going to lose $200. So this defines the risk. Maximum loss is capped here, and that's a very attractive property in an investment instrument. Sorry, Dan, for switching to a different screen. If you want to share that again, I don't know.
No. I turned my screen off. That was my first section I wanted to show, and I think this is a really helpful diagram for everybody. maybe we go into a put option. If you pull up a put option, we could talk about that too, just to show the other side, or talk a little bit more about calls. It's complicated. It just takes a lot of time to internalize.
Yeah, I can find a similar one for puts. Very easy to find these. Just
So I think the point of this is like it's hard to understand because you've got this options contract, right? It's like, oh, it's only worth something if it goes above this strike before the date. But it's a market, so people are always speculating, and different participants have different information. And so these contracts, while they may not have intrinsic value, you might not be able to buy the underlying for less than you may not be getting a deal on the underlying. People are still paying for this contract because they think in the future it will be worth something. And this is kind of the speculation you take as someone purchasing options. And so in our case, if you're speculating on the price of Bitcoin, right? And in Sina's case, he thinks Bitcoin will hit 300,000 next year. If you think it'll hit 300,000, then you have to decide, okay, how much am I willing to pay or bet that it will be 300,000 and to give me the right to buy it at 150,000. And so that is the kind of mental equation you're doing when you're purchasing these contracts.
Yeah, it's super interesting, man. It's because it does come down to like your conviction level, your like probabilities play a big role here. But the more you understand Bitcoin as the core asset, and the more you understand MicroStrategy, the more you can kind of play these sorts of you can understand these sorts of things better, and maybe have more insights into how you could use some of these tools. I look at it as I guess maybe this is not the best way to look at it, but you can let me know what you think. It's almost like this perpetual auction that never ends. With just so many different ways you can play this, or so many different things. It's just ongoing, right? Maybe that's one way to look at it.
Exactly.
I would say even Bitcoin itself is an option, is a call option, because you're paying a small amount of money and you're speculating on the future of financial world, right? So your loss is capped to the maximum amount that you've invested. But if it actually pans out, a huge portion of the financial world will be running on Bitcoin. So you benefit from all that upside. So it's kind of an interesting way to look at it. And if some of the work that Greg Foss has done, he's also looked at Bitcoin from the options perspective, but Bitcoin has options on sovereign debt default, essentially as insurance on sovereign debt default probability. And he has run the numbers to value Bitcoin based on its option value that way. So you could look it up. There's a Bitcoin Magazine article. He goes deep on that, but that's kind of takes the discussion into a philosophical side. But here's our put option example. Again, you buy a put option. Put option is insurance on the price. Basically, if you buy a put option, you buy from someone else the option to sell your asset at some low price. Now, why do you do that? Because if you worry that the price might potentially come down a lot, you can get the option to sell the asset at a defined price. So that gives you assurance. You can never lose more than that, right? So, and that's a hugely important property. Like at the top of the bull market, when you fear that maybe the asset has gone really, really extended, you don't want to sell. That's not a great strategy typically, because humans are not really good at timing these things. But instead of selling, you can buy put options that will just insure your holding against a significant price drop. So it's still you pay a price for that insurance, but that's the whole point of insurance, right? Now, how does it work? Dan, do you want to explain this one?
Yeah, absolutely. It's like a call option, but in the reverse direction, right? So here you can see you have a capped loss if the price of the asset goes up. So you're effectively short the asset in this direction. So if the price of Bitcoin goes up in this case, and you're holding a naked put, so you're just holding this put, your downside is capped. You lose everything if Bitcoin goes up by the expiration date. But if Bitcoin goes down, You slowly begin to make profit until your break-even point, which is where you recover the premium you paid, and then you get a leveraged return as the price of Bitcoin continues to fall in the case of this example. And I think this idea of insurance is exactly correct. And the insurance comes in when you own this put option together with the underlying asset. So the payoff diagram looks a bit different because you hold the equivalent, Bitcoin, for example. And if it goes down, your maximum loss would be capped at the premium you paid, for example. Or it doesn't work exactly like that. There's a couple calculations you have to do. But ultimately, if Bitcoin goes up, you own Bitcoin and you own a put option. The worst that happens is the Bitcoin goes up and you lose your premium. So you're still could be net positive in that situation. But if Bitcoin were to go down, your core holding, your Bitcoin, would decrease in value, but this put option would increase in value simultaneously, which would net each other out if you have the same number of shares and have a fixed floor. So maybe the worst you could lose in a bear market would be 30%. You could design your strategy.
That's amazing, man. Like it's just, I never really looked into this too much, but it is quite interesting because you're essentially, I like the insurance analogy, because you're essentially saying, so you're essentially, worst case scenario, if the price goes up, I guess you're giving up a percentage, depending on how you structure it, you're giving up a percentage of your upside to have an insurance that you're not going to lose the downside. So you're essentially putting a floor on your gains, a floor on your losses in exchange for a percentage of your upside moving forward. And depending on the demand, it'll figure out what that trade-off is. What would be the difference between say someone's like, okay, we're going to go to 250 or something, just as a number. Don't take this number. I'm just throwing out a number. Say someone's like, okay, I think by the end of next year we'll be at like 250, and I want to hold those gains. I don't want to lose them, but I think we could still go higher potentially in 2026 or something. If someone were to, like, what would be the pros and cons of someone buying that option now versus waiting closer to the date? Because if you wait closer to the date, isn't there going to be a crazy amount more demand for that option? Because at that point, everyone's going to want to have that insurance. At this point, a lot of people are not convinced we're even going to get there. So wouldn't the insurance be cheaper to buy it now? But then there's like a theta decay, isn't there? If you hold it now, then you got to pay the whole. But maybe it's like paying rent that's $100 a month for a year versus paying $1,000 a month rent a month before. Like, what's the difference there? I guess you got to do those calculations. But you can get cheap rent now, but you got to hold that rent for a longer time frame. Versus, like, I'm assuming it's going to be expensive. Like, what's the demand going to be like for options when Bitcoin say over 200,000 and everyone wants to buy insurance because they think it could still go higher?
Before Dan answers this, I'll tell you the team who solved this and actually figured out how to value options got the Nobel Prize for it. So this is the magic. This is the important part to kind of mix everything you said about timing, about the strike values, and about probabilities, combine all that into a valuation model for options.
And it's not like you run out of options, right? It's just a price thing. So at some point, the market would just keep increasing the price until someone is willing to buy it or sell it. Like, it's not like we're out of options. Sorry for my beginner questions, but is there a point where it's like, sorry, we're sold out? Or is it just like, no, if you're willing to pay this, you can buy it?
My understanding of it is that a lot of these options are sold by market makers. So like Jane Street or Acuna Capital, they'll sell you one of these contracts, right? But they're not taking the other side of the bet. They're hedging it with their own like counteracting position. And when they do that, they're making money off the spread. So they sell you when there's a bid-ask spread on every one of these contracts, which is the price at which they're willing to buy it and the price at which they're willing to sell it. And they do it 1,000 times a second. And they're making money on this spread. And then they're fully hedged. So they're not positioned directionally. And in those scenarios, there should be plenty of option contracts to go around.
Okay, I assume there was someone else on the other side of the trade, but there's not necessarily the case because they're hedging, like you said. So they're kind of giving you that and they're taking the spread. So in that case, there shouldn't be a limit on it. It's just they have to price it though somehow. How did they decide then if they're hedging? Like, how did they decide it? I guess you said it's the mathematical formula that factors everything in.
I think Sina, you probably have some experience with this.
Sorry, I'm asking so many questions. Maybe we should go back to the original question. I'm jumping all over the place here.
No, I like this. I think this is.
So I'll give you an example. Like, if you want to buy a call option, someone on the other side should sell the call option to you. Could be the market maker, could be someone like me. And that person should have enough assets in reserve to actually make good on the promise. Remember, it's a promise, right? So if you buy a call option from me, I am promising you to sell you 100 MicroStrategy shares at a certain price. I have to have that amount. So the way it works is, unless I'm getting a wonderful deal from some sort of leverage on another asset, I have to have that amount of shares set aside. So it gets kind of locked. Same thing if you buy put option from me, I am guaranteeing to you that if the price goes down below the strike price, I'm going to be willing to buy that asset from you at the agreed upon price. So I should set aside cash. And when you sell these options on brokerage platforms, they will actually keep some of your assets in reserve to cover that. So there's always this other side that's available or locked until the option is exercised.
Yeah, it's a really good way to put it.
Yeah, and just the other question that I kind of said already is just the one to do with how would you assess the game theory between, because I'm sure this is a calculation that people make, if they've already decided they're going to take an option in the future, how do they decide how close to the date of that event they want to take the option versus saying, okay, taking it early versus late? Like, how do people typically assess that, or how are you guys assessing that with MicroStrategy? Assuming you guys are using, I guess, put options, how are people kind of assessing the trade-off between getting them early versus getting them closer to when they might need them?
So listen, the closer. Yeah, go ahead, Dan.
No, I just think you're asking the exact right questions, and even the best traders are constantly trying to figure that out every single day. It's when do you buy it? How long do you hold it? When does that theta decay, which is time decay of the option, kick in? So there's just that's the key question. Go ahead, Zena.
Yeah, I'll just give you an example that I'm familiar with. Right now I have a position where I have sold a bunch of put options that on IBIT that are equivalent to price of Bitcoin reaching 85 in 2 days, by Friday. What are the chances that Bitcoin will hit that point? What do you think? What's your best guess? Like in 2 days, it's actually one market trading day.
I think it's a low probability.
Very, very low probability, right? So that option, the closer we get to the expiration date, which is we're already there, just the less likelihood that this option is going to be of use to anyone. So as we get closer to the expiry, that option's value goes down for the person who bought it. But for me, I'm just going to sit on it because it's going to expire worth less for them. And the premium that I collected is just going to be fully mine. Right now, it could be partially mine, but if I just wait until the end, I'll collect all of it. So there's a decay, but at the same time, very early on, the chances that you make the right guess are slim unless you have significant edge over everyone else. But as you get closer and closer to that expiry, your thesis pans out, and at some point you see that the decay that you're getting is stronger or more detrimental than the potential upside that you might get. So let's say I bet on price of Bitcoin reaching 150. If it's now a month before the expiry and we are only at 120, it's a very risky situation. So my option is going to lose a lot of value pretty soon. So I better get rid of it. So That's one way to think about it. Like if from now until the time that's left, if you still believe there's a good chance that you will reach the strike price, you will stay with it. Otherwise, your thesis essentially has the risk of not panning out, so you get out of it. Does that make sense?
No, it makes sense on my end. And I'm assuming it makes sense for Dan. But yeah, I understand it. So if I understand it, he probably understands it. I think that's safe to say.
Yeah, I think these fundamentals and quite frankly, I think that most people who are entering the Bitcoin options, the MicroStrategy options, like the fundamentals are the key part. Like you don't have to be trading high frequency algorithms to learn about options. And options in a short time frame are very probabilistic, as Seen is saying. So you have to be very careful. Short time frame options are very tricky, but a lot of us have bet long term on the trajectory of Bitcoin, which is something you can do using these call options. And it might pay out handsomely or it may not, but it's an interesting way to add spice. And as Seen is doing, there's also volatility and theta decay, which you can capitalize on by selling some of these shorter dated options. So it's a super crazy landscape. There's a lot of interesting things you can do.
Can you give us some examples without giving away the names of the people, because we don't need to give the names of the people? Can you give me, because you're in this community that's doing this, can you give me some just maybe a couple examples of some of the stuff people are doing that is relatively common in the
Yeah, sure.
We're not advocating these strategies, but I'd like to kind of get a sense of like what kinds of things people are doing. I guess what bets they're taking without the names.
Yeah. Do you mind if like some of these guys have channels? Do you mind if I share them?
Well, I don't care if you give the names if you don't think they would care.
Okay. Yeah. These are some. So I know Nithu. I forget his exact channel, but it's Nithu. He's a covered call seller, and before he was a MicroStrategy, he would sell these call options and collect that premium, and that was how he made his money. So, some people are able to leverage its premium and treat it as income, or trade the premiums, and that's an interesting way to do it, right? And even if you have a bunch of Bitcoin, let's say, I know British Hodl has talked about this, but like, let's say you own a bunch of IBIT ETF, right? And you need to pay off your credit card bill. You can sell a call against your shares that's very far from the money, out of the money, unlikely to expire in the money, and collect that premium in a week or 2 weeks or a month. And that can be a really useful tool. So Nithu on that. But then, for example, other people, like there's this guy called Ladder Climber, Climb the Ladder. He's an anonymous account. He's had incredible gains using long dated call options, right? When FTX collapsed, and a little bit after that, he made a directional bet on MicroStrategy by purchasing the right to purchase MicroStrategy shares at what is now, $40 stock adjusted. And that was a leveraged play that, increased quite handsomely. So there's some people are taking directional bets like that. And other people, I myself, if we see a lot of euphoria in the bull market, I might, instead of taking some off the table, I'll use puts, because this is another interesting implication. It's like, okay, if I sell anything, best case, it's long-term cap gains, and I have to pay state income tax. I live in the US. You can buy puts by borrowing against your shares, right? Or your IBIT. Let's say you have IBIT, it's marginable. You can borrow 20% or 15% against that and buy puts. And so instead of automatically having to pay your gains to the government, you can take this conditional bet saying that if Bitcoin goes down, I'll have to pay the gain on the put option. But if it goes up, that put will expire worthless and I'll never have to pay taxes on it. So there are some interesting strategies that you can do there.
So you lock the price for yourself, right? So you
exactly.
Yeah.
That would be probably the thing I'd be most interested in, would be, for myself personally, would be the insurance component, where instead of selling a bit at the top of the cycle, I would instead, like you said, for the tax reasons, would instead use this sort of strategy. So are you saying that you, in a situation where you borrow against your stack of Bitcoin, a percentage so that you could buy a call option, would that call option then essentially, you still have the decay and the cost of the call, but you know what I'm trying to say? Like, does that reduce the costs? I guess if you're borrowing against your stack, you're taking on additional risk.
I mean, it should be directionally hedged, right? Because you're borrowing against your stack, but you have an option that moves, in theory, exactly opposite of the price of the underlying.
So if the price tanked like 80% and you're getting liquidated on your stack, you still have the call option that would counteract all those losses.
Exactly. And it's difficult, right? Because
well,
you
it
have
makes
to
it safer to borrow. Would it make it safer to borrow in that situation because you are hedged?
Yes.
Because if you didn't have that hedge and you borrowed, then you could, obviously be in trouble if it really tanked and then you'd get liquidated or something. You couldn't cover that. But yeah, so okay, interesting. So, but going back to the call option, no, I mean it's like a whole nother world. I mean, I think just there's a lot of potential, obviously, to generate passive income for people to understand these strategies, and then there's obviously ways of creating leverage, and then there's ways of using it in insurance. So it seems like to me the biggest thing it does. I mean, there's a reason why it's called options. It's essentially increasing the spectrum of things you can do. Like it just gives you tons of more options. I mean, that's what it is. It's just like, rather than just buy or sell an asset, you now have like a whole litany of things you can do, and you can get
So
down.
imagine, I mean,
Yeah.
you and I have been working a lot on probability models, right? So if at some point Bitcoin goes so high that we believe it's right now, for example, the downside risk is significant compared to the upside, we can say, I'm gonna forego further upside. So you might, like, let's say we reach 300K. At that point, I guarantee you there's going to be 1 million influencers on Twitter that are going to say 1 million next month. Okay, so they're willing to bet on something like that just because of the recency bias. To those beautiful people, you can sell the call option. So they would speculate on Bitcoin reaching the 1 million. You can convert it into a MicroStrategy version, of course, but massive gain in Bitcoin from that point on. Somebody will pay you a premium to get that option. You can sell the call option to collect that premium, and if your analysis is right, Bitcoin will never reach that point within the time frame of the option, and then you just collect the premium. So this is what people say, like, being able to generate income off of your stack when it goes up a lot. You sell the huge upside for some premium, and if it actually gets there, you are happy because you're selling it at a much higher price. So it's basically like I'm resigned to the fact that if Bitcoin doubles, and I'm willing to buy that. I'm willing to sell it at that price to someone else. But this is mostly profitable when you have an analysis that tells you this is not likely. This reverse is also true if you feel like a significant drop is less likely. Say, like you said, like Now was saying, after a horrible event, after a massive crash, everybody's bearish. So they're going to pay a lot of money for insurance on the downside. If you feel like going significantly below that is less likely, you can now sell the put option and generate some premium. Alternatively, if you feel like from this point on, massive price appreciation is likely, you buy the call option. If you feel like from one point massive price depreciation is likely, you buy the put option. So in all of these cases, it just gives you more options, more abilities, because buying and selling a spot may be not as easy or tax efficient for everyone else.
Exactly. Yeah, super interesting. So Dan, what's I guess what ways, if you don't mind sharing, like what ways are you using options, and I guess like what has drawn you so much to MicroStrategy? Like just in general, like you seem to be gravitated to MicroStrategy. I'm assuming you're also big into Bitcoin too, but MicroStrategy to you and just the options, and are you going to be kind of doing the similar things with options with Bitcoin, or is it more just MicroStrategy, you think?
It's interesting because MicroStrategy has that, as you said, the 1.5, or as I said, approximately the 1.5 to 2x volatility of Bitcoin. And that volatility makes these options so valuable. And so there's more room to generate a premium, right? Both selling puts or selling calls. And that makes it quite interesting for someone who's interested in options. But I also have bet directionally on MicroStrategy using options. And that, in my opinion, is the absolute best way to do it. I know a lot of people have gotten destroyed recently with MSTU and MSDX. And I think the only way to create maybe a little bit of leverage for yourself is either to take on intelligent leverage in the form of long-term debt, which is something I used for Bitcoin, spot Bitcoin. I took out loans during the whole bear market, and that's how I exercised my my view that I think Bitcoin's going up with a little bit of leverage. But in the case of call options, you can do the same thing. And there wasn't an options market for Bitcoin at the time in the US. But moving forward, now you can express those views using these options in a tax efficient way. And so that's another thing I do want to talk about is like, let's say you've got a call option, and in Sina's case, let's say you think, or in all of our cases, let's say you think Bitcoin's going to 300K and you buy a call option for a year and you have the right to purchase Bitcoin at 150K. If Bitcoin's at 300K and your strike or your right to buy is 150, you can now exercise this option. And this is a huge, huge advantage tax-wise, right? You can now purchase Bitcoin trading at 300K for 150K without incurring a taxable event, right? So your call option contract may be 10x from there, right? So now you have 10x short-term cap gains on this contract if you sold it. Instead, you can inject money and purchase the Bitcoin at 150K, the equivalent number stated by the contracts, and you move forward from that cost basis. So now it's as if you had just purchased Bitcoin for 150K. The appreciation in the option is not taxed. That's a huge advantage if you believe that Bitcoin's going to go above that strike, in my opinion.
Sounds like a glitch, you know, but
Yeah,
it's like a
exactly.
loophole. If you exercise it, your cost basis just resets.
Exactly, yeah.
So it sounds like in general, like as a very blanket statement, it sounds like options across the board, across all the asset classes, the people that really truly understand options at a deep level and utilize it is a fraction of the market, but that fraction of the market definitely benefits from the tax benefits.
Yeah.
Like it's the big players and a lot of the, you know, the whatever, just the more just the more seasoned investors that are using these strategies, because it does require there's a learning curve there, and you know, to understand it. And but there's a reason to understand it, because there are these additional, besides the insurance component, there's actually built-in tax benefits that are quite significant, is what I'm hearing.
Yeah, for sure.
So Dan, I've seen you actually be somewhat specific as well on what thoughts you have, what deals you think are really good. Although this was like a couple months back that I was watching your analysis. So just continuing on Plan C's question about particular strategies, particular thoughts. Again, considering that this is no financial advice, just your thoughts about how you think about these, what kind of deals are attractive to you, and so on.
Yeah, I think I want to start from a broader sense. So something important to think about, and I just saw it in a post that Jesse made. And these, if you buy an options contract and it's say for Bitcoin at 200K by June, and Bitcoin hits 200K in April, right, a couple months before, the option contract will be more valuable at that point because the price moved and there's 2 months until expiration. So people are going to buy the contract from you, betting on Bitcoin continuing to go up above 200. But when you sell that options contract, right, in this case, it's not in the money. You can't exercise it. Most options contracts do not expire in the money. You'll have to pay short-term cap gains on that. So if you're going to go out and try to trade options, you have to be darn well sure that not only will it appreciate, you have to be sure that's going to appreciate faster than just holding the underlying after you pay 37% income tax on it plus state at the highest tax bracket. And that's very difficult to do, right? You have to pretty much double outperform the spot on underlying asset using an option contract, which is very, very difficult. So the way I look at it is options should be played very conservatively. And if you decide to get into an options contract, then it should be done, or ideally it's done in a tax advantage account. You have a lot more expected value in a tax advantage account. That doesn't include selling for premium. In terms of selling covered calls against your shares or selling puts, as Sina's doing, I love that strategy. I think it's super interesting and a great way to generate income. You know, some people hold dividend stocks as income, and a lot of us need to generate income from our investments. So in my example, what I what I do if I need cash, I will sell a very far out of the money call dated for a week or 2 weeks against my own shares. And if MicroStrategy or IBIT doubles, I have to sell them. It's okay. But if it doesn't, I collect that premium and go on my merry way. Similarly, if I have cash lying around, which I might do in a bearish scenario, then I could sell a put, collect the premium, and if not, I have to pay a heightened price for the underlying asset. So I think it just gives you a ton of optionality moving forward. But in terms of trading or looking at deals, again, the implied volatility of MicroStrategy and Bitcoin is so high because we saw this spike. These option contracts are super, super expensive. They're really, really expensive. It's not the same as this summer. And this summer, we traded flat for 6 months. When that happens, these option contracts are very cheap. So I'd say people are starting to get this FOMO and this sort of like, I need to get these options contracts. But it's actually quite unlikely that your options contract in a taxable account is going to outperform your spot shares, even if Bitcoin triples, even if MicroStrategy does a 6x. So something to think about.
Also, if you're paying a lot of money to buy it, if the premium is so high, you may actually be right and price reaches that strike point. But just because you paid a lot of money up front, your break even ends up being much higher. So you might still lose money if you're right.
Exactly.
Like everything else, if you buy it at a time that's, there's a lot of FOMO going, it's very good chance that you can benefit from it. If you have an edge against the market, that's when these things would work out the best.
Yeah.
The biggest thing for me about options is it's not just a bet on reaching certain price levels, because if it was just a bet on reaching certain price levels, I mean, I guess you have to have that time component, because without the time component, I mean, anyone can say, okay, Bitcoin's going to be 200K one day. That's pretty easy call to make, right? But so you need the timing component to it. But that seems to be the thing that obviously a lot of people, maybe they underestimate their ability to be correct on the timing component, and it's maybe something that's a bit elusive to people, where they're confident in their ability to say, okay, I think it'll be here, but maybe they get overconfident on the time component, and that's where people get tripped up. Is that something that is pretty typical, I guess?
The people get tripped up on the timing component.
Yeah, they just get overconfident. Like they basically think like, oh, I know the price is going to get to this level, but then the price does get there. Like, I guess what I'm saying is it's frequent that they're correct, but they're just off on the time.
Exactly.
Right? Like, and it's not necessarily off by that much, because like the precision, I guess people think they can call what I'm trying to say is people maybe get overconfident on the level of precision of calling the price within a too narrow of a window, versus having a bit wider of a window where they give themselves a bit more buffer. Maybe they pay a bit more for that or whatever, but now they're giving themselves a higher probability just because the window is a bit more. So that's what I'm just kind of, people think like, oh, they can call the timing of things, but that's very hard to call the timing component of this. Like being directionally correct or being right about a price within a 6-month window is a lot different than being right about a price within a 1-month window. Like that's a massive difference. Yeah, is what I'm trying to say.
No, that's completely spot on. Yeah, you're totally right. And that's why I never trade short dated contracts. And I think that's why a lot of us would advocate selling short dated contracts, right? I'd personally rather be on the short side of a trade where I'm selling a short dated contract to someone who thinks they could speculate on the price over a short period of time, versus me myself speculating on the price over a short period of time. So that's kind of the two sides.
I would sell short-term IBIT calls, but I can't do it in MicroStrategy because it's just unsellable. The maximum strike you can get, the max strike you can get right now is like, even if you extend it all the way up to September next year, it's I think 1,200 or something. It can cross that threshold in a week. This thing is massively volatile. In one day, it can double, right? So there's no edge there, and the risk is too high if you want to sell something. If you want to buy, it's a little bit less. It's too expensive. So I guess you got to wait until the narrative changes, or whether we have a significant crash, so that these options actually get cheaper. you can't buy and profit when everybody else is trying to do the same. So you have to do your work like Danny and many other MSTR analysts are doing. They understand the future of this asset is really positive, and they are able to put on a bet when no one else is interested. When everyone else is interested, then it's typically late. Maybe you can find an opportunity on the other side of the bet at that point, when people are like overly excited.
I think that's totally right. Yeah, you can take any side anytime you want. That's the beauty of the options market. You can express any view you want over any time frame at any strike price. So it's up to you and your creativity and the models you have to try to make money.
It's all a game of probabilities. Like if you can guess the likelihood of certain events better than the market, then that's when you can bet profit from it.
Exactly. Yep.
What's the upper limit on the duration side? Like, what's kind of the longest? Because I tend to focus on long-term predictions. I just feel like those are a lot easier to predict, and that's just my kind of what I gravitate towards. So, what would be like the longer term with options? Like, what's kind of the upper limits of the duration of that people will do these options for? From a time perspective, like what would be the longest kind of options that are typical?
I know IBIT has 2027, January 2027 options.
So what would be an example of a long-term option? Like, so there's people taking directional bets that MicroStrategy will hit like a certain number. Because what I'm trying to say is if you think it'll hit a certain level, that there's a lot of people that think those numbers are just too high, but it's a multi-year bet, that you could still get a relatively cheap decay. Like your rent on that is
no, but based on the formula, if the length is longer, there are a bigger chance that it actually happens. So they're gonna jack up the price of those calls. So you can
even
bet,
if the number is pretty high, like say there's certain. I know what you're saying. Though.
I see what you're saying. I see what you're saying.
It's a longer duration. It's a longer duration, so the probability increases as you add time. You're increasing the probability, but I guess if the number is higher than people think, I guess what I'm saying is Wall Street might still not think that MicroStrategy is going to be $1 trillion company, but people that are in the space that really understand MicroStrategy and they understand Bitcoin, because like there's a lot of people that would think like there's no way MicroStrategy is ever going to reach these certain price levels because they don't think Bitcoin's ever going to reach those levels, right? So if you're in the market and you're pretty confident that Bitcoin's going to reach these levels, then you can be reasonably as equally confident that MicroStrategy is going to kind of follow that pattern. Therefore, you might be, not following the herd. There's going to be a percentage of people that believe that, but there's still going to be a lot of people that don't. So what I'm saying is these longer term bets, like you still, because the prices might be higher. Like you might be thinking it's going to go higher than a lot of the market still thinks it can get to.
Completely, and a lot of people have made a ton of money speculating in that exact way.
Okay, so they've been confident. They've with conviction and leverage. They've said, okay, I think it's going to get to these levels, and they've kind of were so early on that they've blown away the market because the market just didn't think it was possible. But I guess now it's becoming more and more. People are starting to kind of be like, you know what? I think we are gonna get to these crazy levels. So, but yeah, I mean, congrats to the guys. Like, I think it's still relatively early, but congrats to the people that really love, like, that really made a killing already. I mean, I guess there's people doing options on even MSTU. That's the one. So MSTU is the one that's 2x leverage. Is that?
Yeah. On the it's like 3x leverage on the downside and 1x leverage on the upside these days.
Oh, okay. Oh, wow.
Yeah,
it's no longer the bet it once was, but okay, interesting. Okay. Yeah.
But there's an option market on MSDU or MSDX or both of them, I think. So this gets into a crazy zone. It's already leveraged and you get option on top of it. It's impossible to just have a guess about the price of these things.
Yeah, I thought it was 2x. So I thought my understanding of MSTU was it was 2x leverage. So meaning if the price doubled, you got a 4x, and if the price halved or if it went down 25%, you'd lose 50% kind of thing. And then you pay like a yearly fee to hold that. That's a couple percent, but that's not the case. It sounds like it's really skewed now. It's not. I thought there was even in both directions, but it's not even close to the case.
It's supposed to be. It's supposed to be, but
But
that's
it's not because of
a
demand.
large reason, yeah, why I think we had such a tough day yesterday. A lot of liquidation, because those ETFs, MSTU and MSDX, are a combination of swaps, which are like financial derivative instruments, and options. Like there's a trader who trades for the ETF and tries to keep that 2x outperformance both up and down by buying certain short-dated options contracts. And so when there's a huge crash in the market, then things can go sideways and the ETF may not perform as expected. So it's
interesting. So it's supposed to go in both directions in even amount, but because things can but it's not guaranteed. You're taking on that risk on top of it. So you're getting a 2x leverage, but you're not getting the theta decay. I like that because you're not getting the decay, but you're getting the 2x upside, and then you're paying whatever, a couple % a year. But the biggest thing is you're taking on that risk that things could go sideways, and then it doesn't perform the way that it's kind of advertising that it should. Is that common? Like, how often does that occur? Like that?
Oh, it's leverage ETFs are notoriously dangerous, and one of the phenomenon is called they call it like slippage or something. But it's like, let's say a stock goes down 10%, right? It needs to go up more than 10% to recover to that initial price. So if you're owning a leverage ETF that's performing 2x on a daily basis, 2x the daily price movements as per charter of the ETF, and the stock goes down significantly, you may not necessarily recover back to your previous level.
That's an important point. Yeah, that's very important. Yeah. It's a math principle. It's basically a math principle that's working against you. But I'll let you explain it. Yeah, you can explain it better.
On top of that, because they are futures based, so you get another challenge because the futures contracts may not trade exactly at the spot price. So you may get additional slippage that way. We're getting a bunch of questions.
I'm a huge MSTU bear.
Interesting. No, we should take audience questions because we've asked him enough. Maybe we should let other people have a chance too if there's any audience questions.
Okay. There was a lot of comments that have been posted, but some of them, the discussion has moved away. If you guys, right now we are looking at the questions. If you guys want to ask critical questions again, it's better than me going back, taking a question that was posed like half an hour ago. Let's see. Someone's asking about leverage. This one, I'm not sure if we can offer a clear answer. Is it best to do this within an IRA account to avoid the tax consequences short term?
I'd say yes, 100%. I think you'd agree, right, Sina? It's huge, especially if you're selling calls or selling puts. That's treated as normal taxable income, and you're paying quite a high tax bracket on that.
Exactly. How different is IRA? Okay. Delta administrator option strategy. So people agree that it's very expensive now. What do you do when it's expensive? Just wait it out.
The sharks sell, right? The sharks, like you did, will sell a call or sell a put because the premiums are so high. Or, you still take a directional bet and hope you're right in the direction. Like, for example, I bought calls last spring when MicroStrategy was trading at like $1,700 a share, pre-split. They were super expensive. The volatility was extremely high. And those have gone in the money and now are pretty deep in the money. And so I got lucky. But my multiple return on those isn't that high, right? Because I paid such a high premium for them. So it's something to consider.
Yeah.
And it's similar to now. If you were to go out and buy a call, there's a high chance it may be in the money next year, right? It may be the price of MicroStrategy might be above the strike price, but you paid, as you said before, Sina, such a high price for that option, you may not be making a whole heck of a lot of money.
So a question might be general. Dan, what metrics do you use to determine premium is cheap on MSTR? Or do you just look at the IV rank or IV percentile?
I do it pretty unconventionally. because my intention for all these contracts is to exercise them. I don't trade them, right? I don't like think, oh, this week it's going to go up, so I'm going to sell it at the end of this week. I don't do that. So I just look at my kind of price targets, how MicroStrategy's been acquiring Bitcoin, fundamental Bitcoin cycles, all the probability distribution models you guys do, and then I make my bets in the right direction. And I'm actually willing to pay a higher premium if I think, my price targets are different than what the market consensus kind of is.
Very good. Next question. Is it worth to pay more for longer duration options when making long-term bets? I'll give you a quick example. I am willing to wait for Bitcoin to appreciate all the way until the end of next year. But because there's a chance that we enter a mini bear market or a real bear market, that's up for debate. I'm not willing to pay a lot more for a 2-year contract because I don't know. My base case is we will get most of appreciations next year, but the day after that may not be that exciting. So at that point, like a much longer bet, which will require a lot of premium, is not attractive to me. So that's one way I think about it. What do you think, Dan?
I completely agree. It's just your own decision of timing. And if you think, like, for example, if you think Bitcoin has a high likelihood of going to 300 next year, but the option contract that expires this spring is half as expensive as the option contract that expires the following winter, and you think Bitcoin will only go to 120 this spring, right? You're better off paying a higher premium for the full appreciation of the asset, as you're saying.
Another one. Have you figured out the annual return of writing calls and what percentage away from the current price do you write the call? 20%, 30%. It's all about it's all about the volatility, right? You gotta guess. Do you think Bitcoin can go up by 30% in a month? I think not all the time, but it is really possible. MicroStrategy, I think it doubled a few weeks back in one day. No, like for the time that maybe it was 2-3 days, but it went up from 300 to 550 or something like that.
Yeah, my data is a little old, but as of this July, historically, MicroStrategy had 11 weeks. That's 11 weeks over 25% annual or weekly return. From Monday open to Friday close. And those have been traditionally during bull markets. And if you wanted to maybe sell calls based on that, you can do your own analysis and look at the probability, but that doesn't account for, catalyst events and, changes in the environment. MicroStrategy, the top performing week as of July was a 50% week. That was last February when it tripled in a month. But I think we probably outperformed that the past couple of weeks.
Okay. Can you walk through a specific call option example? Let's pick the strike, pick the expiry from available sales, and so on. Okay. So let's say we have a model that says, mental model perhaps, or an actual model that says Bitcoin will peak at 300,000 sometime by next December. Okay. So you can be a little bit more conservative and buy a call option for 200,000 that expires by September. There's always the chance that you actually, something happens and things delay. So you have to be a little bit more conservative all the time. But then you also have to look at how much premium are you paying for that, and preferably do this when not a lot of other people are expecting the same thing. So you got to be predicting probabilities better than everybody else. When most people think Bitcoin is dead, but you think fundamentals are great, that's when to put up that's the best time to put up that trade. Right. It just maybe right now is not the best time, but when we had that crash up until 92, it was very clear that people were decent enough percentage of people were bears and expecting price to go further down. So once you get narrative changing, your premiums are optimal, and then you can bet big based on your fundamentals, your fundamental analysis. Is it better to exercise or sell?
That's a tough one, because depending on how far to expiration and how deep in the money the option is, there's different pricing, right? So if the option gives you the right to buy at a price that's much lower than the market value, that's a great time to exercise, because most of the profits link to that intrinsic value. However, if there's a few months to expiration and the price of the underlying or price of Bitcoin is trading at the strike price, but all of that premium, the money you've made, is based on the future value of Bitcoin maybe going above or maybe going below the strike on the date of expiration. In that case, there's no intrinsic value. You can't exercise it. So you have to figure out how much is linked to the intrinsic value, price of the market asset minus the strike price, and how much is related to other factors like time to expiration and volatility.
So what's a good resource to learn about? Do you have anything, or is basically like you study it by search and specific queries, specific questions that come to mind?
I use Acuna Capital. They're an options trading firm. They have a Acuna Capital Academy 101. It's a for anyone who's looking to get hired as a prop trader at Acuna Capital. You take this course, and if you do really well, they'll come and select you, and you can potentially get a job. But it's a free course, options basics, fantastic, really good, super in depth.
How do you spell it?
Akuna. I think Acuna Capital is the name of the prop trading firm, but it's called like Acuna Academy or something. Options 101.
Options 101. Yeah, I see it. So I can actually write it here. Very interesting. Okay, let's pick a few more questions, because we're at 1 hour and 20 minutes almost. So I want to be respectful of Dan's time as well. Can my MNAV? That's a different discussion. I'd argue all the regular strategies breakdown. Okay, so I guess we don't have. What is this one? Yeah, so a question for Dan. It's a longer one. He may hedge his upcoming expiring options to prevent the tax consequences. If that call option is in the money, what happens at the end of expiry if you do nothing? Are you forced to exercise the option, or does the brokerage take shares away and just pay you the total gains from that expiry date?
I think, climb the ladder answered this question. And to clarify that, I'm going to exercise my options that are in the money and then borrow against the shares to insure if I decide to do that. But if your call options expire in the money, then the brokerage, I think, will use your margin to exercise if you have enough margin, which is the borrowing power against your assets. And otherwise, they'll ask you to put up capital. And if not, I think they'll liquidate some sort of asset or sell the contract. I'm not exactly sure how it works.
Okay. Yeah. So let's then conclude and summarize what we discussed. I mean, the way that you think about options, what are the opportunities they open up? And I also just in general like to learn a little bit about your thinking about where the market is at and what are your expectations for next year.
Yeah, I think options, again, they allow you to express things in different ways than just having the bi-directional option to buy or to sell. And they allow for insurance. And if you think, like, you can literally express the probability that Bitcoin goes to 1 million versus it going back down to 70,000 per power law, or whatever, sub 100, optimally using options, right? You couldn't optimally express those probabilities by buying or selling, or you could buy or sell a portion potentially, but you can lock it in better with options. In terms of where the market's going, I'm super long. I think I'm just going to be super long for a while, but I'm not purchasing more options. I know the dip, I bought a couple contracts during the dip, but I think you have to have made your bets and then ride them forward.
Yeah. I just added this very small amount in the dip. but not adding any until there is a bearish narrative coming, or depending on euphoria, but this can go up significantly. So I might actually at some point, if we reach like 300, 200, I might begin thinking about selling some calls, but we are nowhere near that point. I'm just happy to write it out. The last thing I'll say is, guys, be careful. There are many people that want to sell you the idea of options as an easy way to make money. It's not. You only make money if you have significant edge over everyone else. You have better prediction of probabilities, timing, than others. Now, if you've done your research significantly more than everyone else, if you feel like the market is does not understand fundamentals that you do, like a lot of MicroStrategy analysts had, that's a wonderful thing to consider. Plus, you have to understand the theory of the options. It's complex, but the complexity is value, because that opens up opportunities. So if not a lot of people would go deep into these things, and that can give you an edge if you really go down the rabbit hole. Right now, we are hardcore Bitcoiners, and we study Bitcoin, we study MicroStrategy all the time. So it is possible that we do have an edge over a general investor that looks at everything. They're going to have a lot less focus and mental energy to pay the Bitcoin or MicroStrategy. So we can have an edge, but you have to approach this from with intelligence, right? So because you can also lose a lot of money if you do this the wrong way. Some option strategies you can put on which don't have a maximum loss. So you can open up yourself to unlimited losses as well. You got to be very careful. But if you feel like like Dan was saying, you have a view over probabilities of different prices, then you can express them through the options. Is that a fair summary?
I think so. I think it's spot on.
I just had one last closing question for Dan, just regarding, I guess it does come back a little bit to the timing question, as well as speculating on Saylor's buying here. So a Saylor basically laid out this 42 billion over this 3-year window, and it's pretty clear that he's well ahead of that schedule. It doesn't take complex math to figure out that he's bought 12 billion in 25 days. So we don't know if he's going to maintain this pace, but I actually did like a basic regression. It was an 87% fit of the data, and it was kind of showing the trend line of I took all the buys, essentially every buy he's ever done since the beginning, and I just plotted that, and then I just did a regression line going up to 2030. And so essentially MicroStrategy at the current pace, if they maintained it, they're on pace to get to 1 million Bitcoin by 2030. But they're actually really high above they're actually a year ahead of schedule. So what I did is I essentially said where they currently are versus the trend line, they're actually not supposed to be at this much Bitcoin for another year. So they're about a year ahead of schedule for the trend line that'll get them to 1 million in 2030, if that makes sense.
Yeah.
So but it's going vertical. So it's like compared to all these buys in the past, like it's essentially going vertical. So what I'm trying to say is, it seems like he's obviously trying to execute this as fast as possible. That's pretty clear. What's your speculation around that? Like, is I guess the 4-year cycle, is that something that you kind of subscribe to as well? And like, I mean, with MicroStrategy and all these options, I'm assuming that's a huge factor that you're trying to assess. Are we going to have an extended cycle? Are we going to follow the 4-year cycle? I'm kind of adding multiple questions here. You can answer it however you like, but they kind of go together. It's like, how fast do you think Saylor's going to execute this 42 billion? And then to what degree do you think he's just going to keep going? Obviously that depends on demand, and then how much are you kind of assuming a 4-year cycle in your option strategy currently? Like, how big of a factor is it? Or is it something you don't have to be decided at this point in the way you structured things?
Yeah, I think those are all like pertinent questions. And the reason I got into the options was because I believed in the regression and the Bitcoin cycles, or regression towards a mean. and I didn't think it was priced into the options contracts. So that's what initially got me in there. I was like, oh, I think there's a mispricing here. But going forward, I'm kind of, going into the dark here. If we're sitting 2025 at 300K Bitcoin, will I be buying long calls? Like I would consider that to be quite irresponsible, just based on historical data. So I won't. I'll be sitting on spot. I've used the options to express what I have seen as a historical pattern in Bitcoin, which you guys know to be the case, right? But I think moving forward, from there, I will probably be holding spot, quite frankly. I think in an unknown sort of situation, you have to own spot. These options contracts are highly risky, and you do have to be responsible. Like you can use them to apply leverage opportunistically, and I think that's what's so amazing about these option contracts as it applies to these Bitcoin cycles is you can time the Bitcoin cycles using these options contracts, right? And for traditional financial equities, you don't have this kind of cyclical behavior, so the options are actually less valuable because you don't have this window of like real crazy price movement. But when you have this window of real crazy price movement, you can capitalize using options, and that's what I've done.
Yeah,
but when that window ends, I'm gonna change my thinking.
That makes complete sense. Like we do have a lot of unique things about just because of the underlying of Bitcoin, like the fact that it's followed this historic power law, which you're very familiar with, and the fact that there is a cyclical behavior that follows liquidity cycles, and this adoption curve plus liquidity cycle seems to be very cyclical up until this point. And so, like you said, you don't have to take a bet on 2026. That's a little bit more unknown at this, a lot more unknown at this point. But it's a lot easier to make a bet on 2025. Like it's so much easier to make a directional bet on 2025 than it is 2026. So why make the bet on 2026? Why not just hyper focus on 2025 and then play it safe in 2026 so that you don't have to take that bet. So that makes sense. Like the way you described it makes sense. And then just the last question was, which I kind of asked already, was the Sailor. Like, what's the speculation here? When's he gonna go through this? Because I think he could do it within 4 to 5 months. Like, is he really gonna get through this 42 billion? And then, how do you see that playing out? Is it just gonna keep? I mean, gonna keep coming? Obviously,
he's done. He's 60%, 55% done with the at the market selling after last week's announcement, if not closer to 70%. So that'll be done within the year, the 21 billion for at the market selling, in my opinion. The convertible debt has more criteria based on like conversion criteria. So that maybe he pushes the 21 billion worth of converts occurs over the 2025. But there isn't really anything stopping him from selling more shares. There's a way in which they file them in which they don't need like approval or super stringent approval, and a couple of lawyers in the group have better explanations, but they can keep issuing these at the market sellings, and I see no reason why it'd stop. As long as that premium still exists, it's in his shareholders and his own best interest to continue selling shares and buy Bitcoin. I think that he's gonna and look at like all my models from last year. I didn't think they'd get to 400,000 Bitcoin. They're 380 now. Till 2027.
I don't think many people thought they'd be here. I think there's very few people that thought. I thought Sailor, even when he was hitting like 200,000, 250, it already seemed like, wow, we're already at these levels. The fact that he's almost at 400 is, I don't think many people predicted this. I think very few people, if they actually were honest, they predicted these levels so soon, and so it just kind of makes you wonder what's possible. It's just. So, do you think there's a possibility that he's maybe this is obviously speculation as well, but do you think he's waiting for some of these index funds listing or these index listings to have more passive flows before he sells more shares? Because that's, or is that just not as big a factor? Like it's not enough. It wouldn't be at these market. Because I guess what I'm saying is, if he doesn't want to impact the share price as much from selling shares, maybe wait till they're kind of get these index listings so they have more kind of passive flows coming in. Now, as their market cap rises, those passive flows, can offset selling of more shares. So you can kind of, you know what I mean? Like he can kind of wait till the market cap goes up. Okay, we're getting more passive flows. Maybe we're extending the conversation to other topics, but sorry.
No, it's relevant. It's relevant. And you're saying he's constantly selling into the market. He's always selling, and sometimes he does it opportunistically. And when the stock price is crashing, I think he may not be selling as much. But when I think you're right, as there's passive flows and the more buying pressure, he's selling. And I think they take a long-term view. They're trying to acquire as much Bitcoin per share. So, I don't know. I don't know. It seems like they've got their foot on the gas though, and that's good for me.
Awesome. So thanks a lot, Dan, for coming on. I know options and MicroStrategy and Bitcoin and these things are very popular right now. A lot of people wanted to learn about them. Thanks for coming and sharing your knowledge with us. Everyone, make sure to follow Danny. He has a long username, Danny85732 on Twitter. Absolutely worth reading his analysis. You are also on MSTR True North. You have periodic shows which are extremely popular, so I don't even need to advertise those. Fantastic discussions on MicroStrategy, mostly MicroStrategy, right? There.
Mostly MicroStrategy, yeah.
Yeah.
You guys
So
do the Bitcoin stuff. We need to find a niche.
and Bitcoin stuff, yes.
Yeah.
So yeah. Thanks a lot. Appreciate your time, and we'll be watching the market to see where things go.
Fingers crossed. Thanks, guys.
So, man, thanks for coming on. It was great. Thanks a lot.
Awesome. Yeah, really good questions, and I learned a lot from. I think your explanation, Sina, was just so spot on, very clear, and I think the viewers probably really appreciate that.
I appreciate you coming on. Thanks a lot, everybody.
All right, guys.